Yeah, I'll go through the key stocks in my coverage universe ahead of reporting season. So these are the reporting dates. We had Amcor report on Wednesday, and I'll run through that in a little bit. But next week's fairly quiet, and then pretty much all the other companies are reporting in the final 2 weeks of Feb. So Amcor, really good result there on Wednesday. We've maintained the ad rating on a 17.10 target price. On a constant currency basis, the result was ahead of our expectations. BEMA synergy benefits are tracking ahead of schedule. Margins were up, and returns were also higher. Importantly, the outlook remains strong, with Amcor once again upgrading earnings guidance. That's the fourth time in the past 12 months that Amcor has upgraded earnings guidance, and I think really shows the good momentum in the business, despite the ongoing pandemic. Amcor also announced a further $200 million share buyback, and this is on top of the $150 million buyback that they announced in November. So the balance sheet remains healthy, and the stock's trading on about 15.5 times PE, with a yield of about 4.5%. So I still think it looks really attractive for a high quality business. So still comfortable with the ad rating. The key risk in the short term is currency, and just to give you some sensitivity there, a 1 cent fall in the US dollar against the euro and the Aussie dollar decreases our valuation on Amcor by around 0.7%. Woolies and Coles, I think both Woolies and Coles should deliver really good results. The first quarter trading updates were really good, and I expect that positive momentum to continue for the rest of the half. Obviously, international borders remain closed, so during Christmas we had more Australians in Australia as well, which is obviously good. And we've also had a few COVID outbreaks across the country. So there was a few clusters there that broke out in New South Wales in December. Brisbane, as you guys know, went into lockdown for a few days, and WA is now in lockdown as well. So those things, they are good for the supermarket operators. In terms of valuation, Woolies is on about 29.5 times PE with a 2.5% yield. Coles is on about 24.5 times with a 3.5% yield. The key question is obviously how long the strong sales growth can be maintained for, and also all the supermarkets will start cycling that really strong second half or PCP last year, when from that initial panic buying from the onset of the pandemic. But given COVID-19 is still hanging around, and people are still spending more time at home, I think sales could be stronger for longer. I still prefer Coles over Woolies, mainly due to valuation. It's trading on a lower multiple, and you're getting a better yield there with Coles. Wesfarmers, similar to Coles and Woolies, Wesfarmers has been a key beneficiary of the pandemic, with people spending more time doing renovations and DIY around the house. Obviously, Bunnings has been strong. Officeworks has also been really strong due to people working from home more. So I think it'll be a really good result. In saying that, the Wesfarmers share price has been pretty strong over the last few months or so, and it's been particularly strong over the last few weeks. So I think there is some expectation there from the market that it will be a good result. It's now trading on about 31 times PE with a 3% yield. I still really like Wesfarmers. I think Rob Scott's done a really good job since taking over a bit over 3 years ago. But I do struggle with the valuation, so I have it on a hold. But I think it is a great business, and definitely one to put on the watch list if there is a pullback in the share price, potentially around that $50 mark or below. InvoCare, to be honest, it's always difficult to judge how InvoCare's 6 monthly results are going to be, because it depends so much on the number of deaths, and death statistics are not frequently available. What we do know, however, that deaths were down about 2 to 4% in the June half, and given various lockdowns, social distancing, and generally better hygiene, I think there's a good chance that deaths will also be down in that December half. The key question is by how much. So I think the last 6 to 12 months, it's definitely been tough, and I expect a particularly strong result from InvoCare. But I think if you do look longer term, I think the fundamentals for the business remain sound. International borders, they will open up at some point, so we will get migration coming back. And once we get once the vaccine gets rolled out, in theory, we should get more movement and potential for people to get into accidents, etc. So overall, I think it is a good company. I am still comfortable with the ad rating, but I think you do need to have a bit of a longer term view because in the short term, there is still a bit of uncertainty there. And then finally, just on some small cap stocks, PWR and Acrow. On PWR, so management provided guidance in December, so there shouldn't be too many surprises in the PWR result. It's obviously a high quality, founder-led business, very strong balance sheet, and really good track record of earnings growth. The one thing I am concerned about in the short term is currency, which will be a headwind if we do get continuing strength in the Aussie dollar. But from an underlying perspective, I expect the business to be traveling really well. Still comfortable with the ad rating on PWR. And then lastly, on Acrow, it is a very well-run company with leverage to growing infrastructure investment. I do think it is a potential beat candidate at the upcoming result. And the reason for this is management provided a trading update in November. And what they said in that trading update was that EBITDA for the year to date to October was, and they use words such as exceeding expectations, well ahead of PCP, and comfortably ahead of budget. Yet, despite how well they were going, management kept guidance, which was given back in August. They kept guidance there unchanged. So I think, given the strength in the business, I do think there's potential there for Acrow to beat at the first half result, or potential there also to upgrade FY21 earnings guidance. The stock is, trading on 9 times PE with a 5% yield. So, I still think it looks really good buying at these levels.